Hey everyone, welcome to the Greeks Explained. My name's Joshua, the co-owner of Simply Trading. Now today we're going to be going over an in-depth explanation on the Greeks when it comes to trading options. Alright, let's get right into it. So the five Greeks that we're going to be talking about are delta, gamma, theta, vega, and rho. Delta is like the speed of the price movement. Gamma is the acceleration, you can say, of the price movement. Theta is the time to maturity of that contract, or also known as the time decay. Vega is the volatility or the impact of a 1% change in implied volatility. And Rho is the rate of interest. And Rho is only really important if you're looking at a contract with a further expiration date, say 60 days or more. So the first one that we are going to talk about is delta. So delta is the amount a contract's value is expected to move based on a $1 increase in the underlying share price. Calls have positive deltas, puts have negative deltas. In the money contracts have higher deltas, and out of the money contracts have lower deltas. So if we look at this here, this is a options contract spreadsheet. And if we go ahead and look at this one right here, this 285 share price, this guy, yeah, this one right here. Okay, so we can see that the delta on this one is 64 cents per contract, or per share of your contract, and each contract is 100 shares. So if the price of your contract was to go from 286.64, or if the price of the underlying share, I should say, should go from 286.64 to 287.64, your contract value will increase by $64. Okay, now if you have a call and that dollar goes down instead of going up, you will lose $64 worth of value of your contract. Okay, now let's look again down here at this 288 strike price. Now we can see that the delta on this guy is 38 cents. Okay, now if this underlying share price was to go to $287.64, your contract value would increase by $38 because you're multiplying this number by the amount of shares within your contract, which is 100 typically. Okay, so next we're going to talk about gamma. So if delta is the speed, gamma is the rate of acceleration. All right, so contracts with a higher gamma are more responsive to changes in the underlying share price. And gamma is the additional price movement of your contract value. Gamma is highest at option contracts that are at the money, that have at the money strike prices. So again, we're going to look at this 285. Okay. And if we look at our gamma right here, we can see that the acceleration, or however much additional value we'll get per dollar increase, is $8. We have an 8-cent gamma, so that means every time after the first dollar increase, we will have $8 in additional revenue. All right, now we're going to break this down a little bit more. So let's say we have a strike price of $54. We paid $3.30 per share of that contract. Our delta is 45 cents, and our gamma is 5 cents. When this underlying share moves up $1, right, to this $55 range, our options price, our option value, is going to increase by delta. Okay, so we gain 45 cents, and now we're at 3.75. And for the second dollar that this moves up, we are also going to gain our gamma value. So the first time it went up 45 cents, the second time it went up 56, the third time it'll go up 55 cents. Okay. Now, the next one that we're going to go over is theta. Now, theta is time decay, and it's the #1 enemy for option buyers. Theta is super good for option sellers, though. Theta is the amount of value lost in your options contract every day within the time period that you own it. Theta accelerates closer to the expiration date. So maybe you have a contract that expires in 40 days and your theta is really low. As that expiration date gets closer, that theta will actually increase. And theta is always a negative value because it always has a negative impact to your contract value. All right, so again, we're going to look at this $285 strike price. Okay, and now we'll come down here, look at our theta, and our theta is negative 0.87. So that means for every day that you hold this contract, you will lose $87 in the contract value. And remember, the closer this gets to expiration, the higher that will get. Now, if we look, this expires in 1 day, so it has a pretty high theta already. If you were to choose a contract with a farther away expiration date, that theta would be much lower. So again, every day that you hold this options contract, your option value contract will decrease by $87. Okay. So now we're going to go ahead and look kind of more in depth on this. So why does theta cause decay in value, and where does that value go? Where does that lost value end up? So when you're buying an option, theta decays the value of the contract over time, but the value must go somewhere. And now on the other end of buying options, you're selling options, okay? When selling options, you gain value from theta. As buyers lose value, the seller gains value. If we look at this little diagram here, we can imagine that these are the buyer's value, and this is the seller's value. So as we are losing that money on the buyer side, the sellers are gaining that value from theta. So the buyer's lost value is the seller's gained value. So now we're going to talk about Vega. Vega is the amount a contract value is expected to move based on a 1% change in implied volatility. Implied volatility is the only unknown factor for options traders. Okay, and Vega has a stronger effect the further out the contract's expiration date is. Now, if we go back here, we can see that we know delta, gamma, Vega, and theta. Okay, but we don't necessarily know the exact implied volatility. We have a rough idea, but it changes, and there's not really a strong way to predict that change. So if we look again at the same strike price right here, $285, okay, we can see that our Vega is 0.056. Now, every single time our implied volatility goes up 1%, we will gain this value. So if this goes up 1%, we gain $5 in value. If it goes down 1%, we lose $5 in value. Okay, let's look at this a little bit more in depth. So if we're paying $3.50 per share of our contract, and our implied volatility is 119%, and our Vega is 0.4. So let's say our implied volatility went up to 120%, so it gained 1%. We would also gain this 40% value onto our share price. Okay, so we can see that it went up from 350 to 390. Now again, if it goes up another percentage, we will gain an additional 40 cents in value per share. Now if times that one by 100 shares, you would be gaining $40 in value for every 1% increase in that implied volatility. And that does have a negative effect. So if we are 120%, and it goes down to 119%, we will lose that 0.4 cents in value, okay, and our share price will go from 390 to 350, okay? So you can lose $40 of your total contract value on that 1% drop in implied volatility. All right, that's it. I hope you guys learned something from this. Go ahead and leave a thumbs up, leave a like, subscribe, let us know how we did. And if you have any questions, be sure to drop it in the comments section. And I'll also leave a link to my Discord channel if you are not already a part of that.